Hi everyone. So in this video we'll talk about the Indian stock market if we are really heading for a big crash. So we have been listening to multiple headlines that Indian economy is slowing down and it is showing signals similar to the last financial crisis that happened in 2008, and also they are comparing that Nifty P is historically at high values when compared with the previous last two crashes. So in this video we'll check the last 20 years of Nifty data, and we'll check if there is any similarity that we could find out. So people usually talk about the Nifty PE ratio. So since it is currently at all-time high, and people believe that the market is headed for a big crash right now, because earlier when the same kind of thing happened, it happened in the year 2008 where Nifty PE was around 25 or 27. So it eventually crashed. Similarly, it happened in the year 2000 during the dot-com bubble burst. So based on that, people have derived this kind of an illustration where if the Nifty P is no less than 12 or 13, it means that it is available at a very attractive valuation. So you could go and invest money. So if it is higher than 26, it means that the market is at an extremely high valuation. So it could head for a crash. So this is the last 20 years of Nifty P ratio historical charts. So starting from year 1999 to 2019 it is available. So in this period there were two major crashes that we have witnessed in Indian stock market. One is in the year 2000 due to the dot-com bubble burst, and the next one is in the year 2008, which happened due to the global financial crisis. So in both the cases, if you observe, the Nifty P ratio started now going into the overvalued zone. So by the late 1999, from the year Jan 2000, or the P was extremely high. And eventually, what followed was the market started crashing from the year 2000 Jan or Feb onwards. And the chart that you see right now is the Nifty historical chart for the year 2000 to 2001 end. So if you observe, the market was extremely going higher and higher prior to 2000. The Nifty was around 1800 levels, and from 2000 first part when the Nifty was at all-time high, their PE ratio was around 27.12, and then the market started going down and down, and eventually from 1800 levels it crashed to around 850 levels. Around there was a 50% drop in the Nifty index itself, where at the start the PE ratio was around 27.12, and by the time the crash was over, the Nifty PE came down around 13.65. So just like the year 2000, and the market again started becoming expensive by the year of 2007. So Nifty was extremely going higher and higher each month, and similarly the Nifty P ratio was also moving higher and higher. So by December and Jan, the Nifty P ratio almost peaked out at around 26.55 levels. So the chart that you see now is for the year 2008 of Nifty, where at the start of the year the Nifty was around 6,300 levels, and by the year end, even by the end of October, Nifty almost cracked down to 2,500 levels. And if you observe the PE ratio levels at the start of the year 2008, Nifty PE was around 25 to 26 levels, and then onwards the crash started happening, and eventually the market crashed down, and the PE ratio from 25 came down almost to 13 levels. So if we go by the same logic, what we have observed in the year 2000 and what we have observed in the 2008, the Nifty P ratio, started going into the higher valuation zone of more than 25 or 26 by the end of 2017 itself. However, if you observe this particular chart, once Nifty P ratio, came to this level, we were only seeing market crash followed by. However, post 2017, the Nifty P ratio was kept on going higher and higher. Earlier, the peak level was around 26, but it crossed the 26 levels. Again, in the year 2018, it went up to 27 levels, and almost the Nifty PE high ratio is almost now 29.25. That is the all-time high P levels right now. So compared to the last two no stock market crashes, the current P levels is extremely higher than what we observed in the last two levels, but still the market haven't cracked yet. That is because of one main reason. So even though the Nifty PE ratio is at all-time high, which is higher than the last two stock market crashes, we haven't seen a huge sell-off in the Nifty index. Even if you see this chart of 2017 to 18, market kept on climbing higher and higher. Where by the start of 2018, the Nifty PE ratio was around 27.2, but still there wasn't no big selling that we have seen. Eventually, market kept on moving higher and crossed 11,500 in Nifty, and it had a new PE high of 28.2. So there were intermediate, a small sell-off that we witnessed, but eventually market recovered every time, and it kept on higher and higher, going higher and higher. And even now the PE ratio is around 28.2, which is still larger than what we have seen in the last 20 years. So why is it that Nifty haven't seen a significant correction or a big fall like it happened in the last two times when the Nifty is at Nifty P is at all-time high? Is mainly because there is another ratio called Nifty PB ratio. So price to book value ratio is another standard term which people use to find out whether the market is really expensive or it is available at attractive valuations. So with respect to Nifty P ratio, if it is available at greater than 4, it means that market is at extremely high valuations. If it is available at lesser than 3, then it means that the market is available at a very good valuation zone, so people can get into it. So when it is greater than 4, it means that it is highly valued. When it is lesser than 3, it means that it is fairly valued. People can buy it. So that is where, if you see in the year 2000, at the start of the crash, the Nifty PB ratio was more than 4, 4.5 or 4.6. And then the market started crashing. Similarly, if you see in the year 2007, earlier the 4.7 was the peak, and the 2007 it seemed that it crossed 4, and then it went to 5.8, and eventually it went up to 6.2 levels, which was the highest that we have ever seen. So the Nifty, when it was trading around the year 2007, the PB ratio was around 6, so which is extremely high. However, if you see the current P ratios after 2008, we haven't gone into the danger zone as per the PB ratio. So we haven't even crossed 4 ratio. We've been still low in the around 2.8 or 2.5 or 3.7, something like that. But we have never gone into the red zone or orange zone. So even though the Nifty P ratio is extremely high, the PB ratio has never seen the last two crisis period levels. So it never even crossed the 4.5 levels. It is still trading way lesser than what we have seen in the last two crisis period. So even though the Nifty P could suggest that we are in an extremely danger zone, but when we compare the same thing with the Nifty PB chart, it is seen that we are still not anywhere close to what we have witnessed in the last two crisis period. And if there is only one thing that is completely different in this period is the mutual fund investments. You would have seen multiple ads everywhere about the mutual funds I had, where the first time investors in the markets has been increased exponentially when we compare it with the last 10 to 20 years. And this is the assets under management for equity funds with respect to all the mutual funds in India. If you could see the crores of investment that is coming year after year has been increased exponentially in the last 10 years. This is mainly because of the more awareness that is created by the government about mutual funds, and more first time investors who haven't seen any big crisis are coming into the markets. And day by day, then the mutual funds investments is growing and more people are getting into it. This chart right here shows about the FII activity in Indian stock market. If you observe from 2014, after 2015, the FIIs have been steadily selling, even though the market has been climbing up from 2014. The FIs are the net sellers in Indian markets. They haven't invested much in the last 4 or 5 years. In fact, they are continuously selling each and every year. So if FIs are selling, so who's buying in the last 5 years? So it is the domestic investors, the mutual funds, and all these firms. They have been continuously buying and buying since 2015. So as we saw in the earlier chart, people were investing more and more through mutual fund investments in the last 5 years, and all these funds inflow has helped the domestic investors as mutual funds companies to increase the buying activity, and they have been steadily buying year after year. And if you could see the year 2018, it has seen the highest purchase that has ever made by the mutual fund industry in the last 10 years. So the real threat would come from the mutual fund industry. It is not only because of Nifty P ratio we are going to crash, or not only because of PB ratio. It could be from the mutual fund industry. It's mainly because, as you see, the AUM has been kept on growing higher and higher, which means that a more number of crores of investments are coming into the mutual fund industry, and the FIs are clever and they have been selling it now since the last 5 years, and there is no buying activity from FIs, which is considerably very less in the year 2019. So if all these investors who have invested through mutual funds, if they start going for a redemption, if they see that okay, economy is weak and market is going down, it is not seeing giving much good returns, and most importantly, all these mutual funds first time investors are first time investors. They haven't witnessed no greater volatility in the markets. So if they tend to panic and if they start pulling out their redemptions, and that is going to have a significant pressure in the Indian markets, because already FIs are selling, and if the mutual fund industry, if they also wanted to sell, there isn't any buying pressure that would come, and there is nobody there to buy the other side. So if more people start to withdraw their funds, we could see a severe impact in the Indian stock market, and due to the liquidity crisis, and that impact would be much worse than what we have seen in the last two crises. So to conclude, even though the Nifty is historically at higher P levels, the Nifty PB ratio is still not anywhere close to the danger zone of what we have witnessed in the last 20 years. So if there is one thing that we need to fear of, it's mainly because of the mutual fund industry. They have been a consistent buyers for the last 4 or 5 years. If they start selling, then it could have a severe impact. So the two metrics that you could watch out for is find out if the PB ratio is getting into a danger zone, and second thing, and find out if the DAs or the mutual funds, if they start selling, be the first to get out. So this is what I wanted to share. So that's why I've taken the last 20 years of data and did this analysis. So if you guys have any other thoughts on this, or please do let us know what do you think about the current market scenario in Indian markets. Please share the same in the comment section. Thanks for watching.